All asset markets experience upswings and downswings: stocks, bonds, crypto, commodities, currencies. But what they all respond to are the changes within the economic system and the financial system. The economic system produces an economic cycle of growth and inflation. The changes in growth and inflation are how we analyze the different economic conditions, and assets behave differently under different economic conditions. Asset prices anticipate and react to the changes in the economic cycle. The financial system produces a financial cycle of interest rates and liquidity. The changes in interest rates and liquidity are how we analyze financial conditions. Assets behave differently under different financial conditions. Financial markets are constantly anticipating and reacting to changes in economic and financial conditions. Therefore, the financial and economic cycles play a dual role in driving asset prices. If we break down these conditions, we get 4 macro variables: growth, which is production, consumption, and employment; inflation, consumer and producer prices; interest rates, the cost of borrowing money or the cost of financing; and liquidity, the amount of money circulating in the system. Markets are constantly adjusting to what they expect from these 4 macro variables. Assets are driven by expectations of the future, expectations of growth, inflation, interest rates, and liquidity. Now, we can't predict the future, but with the right variables and by understanding the mechanics, we can forecast a higher probability of outcomes into that future. So let's dive into these key macro variables, how they impact each other, and how they impact different types of assets. The purpose of tracking the financial cycle is to determine whether conditions are supportive of growth and investment or restrictive for growth and investment. If they are supportive, we call this easing. If they are restrictive, we call this tightening. Therefore, financial conditions are either easing, supportive, or tightening, restrictive. Okay, now that we got that, let's talk about the tools. Interest rates are the cost of borrowing money, the cost of financing. Pretty straightforward. When interest rates are lowered or set at a low level, this is considered easing or a loosening of financial conditions. Now, let's say you want to finance a home with interest rates at 5%, making your payments around $3,000 a month. You want to purchase the home, but you wouldn't have much money left over to save, spend, or invest. This makes money tight. Now, if interest rates fall from 5 to 3%, you'd be able to finance the home at $2,500 a month. That puts an extra $500 a month in your pocket to spend, save, or invest. The drop in interest rates makes your financial situation easier. Financial conditions have eased. On the flip side, when interest rates rise, financing becomes more expensive, leaving less money to spend, save, or invest. This makes financial situations tighter because financial conditions have tightened. So when the Federal Reserve raises interest rates, the growth cycle begins to slow, and when they cut rates, the growth cycle recovers. Therefore, lower interest rates are one form of easing, and higher interest rates are a form of tightening. Okay, now let's move on to liquidity. Liquidity is the amount of money or credit flowing in or out of the system. Let's say you own a construction business and you're financing the cost of your expenses. You're able to borrow up to $1 million in credit or liquidity. But in order to scale your business, you need more funding, more credit, more liquidity. When liquidity increases, businesses, consumers, and investors are able to extend their credit, borrow more, spend more, or invest more. This leads to an increase in economic activity, higher levels of employment, and higher asset prices. An increase in liquidity makes money more available, leading to an easing of financial conditions. Government spending is fiscal liquidity because money pours into the economic system from the U.S. Treasury account. They're basically crediting the economy with new money. Monetary liquidity is the central bank purchasing assets from banks, essentially crediting the banking system with cash, which allows them to create more loans, more financing, or purchase more assets. The strongest form of liquidity is when fiscal and monetary liquidity happen at the same time. The government credits the economy and the central bank credits the banking system. Boom, more loans, more financing, more consumption, more production, more GDP growth, revenues and profits increase. Anytime the central bank creates a facility that provides liquidity to the banking sector, they are increasing liquidity. On the flip side, when liquidity is reduced, there is less credit available, less financing, less investment. Less available money means businesses, consumers, and investors must tighten their spending to match the reduction in credit. This is a tightening of financial conditions. When liquidity increases, it gives a boost to growth, and when it slows, growth seems to struggle. So interest rates and liquidity are either easing financial conditions or tightening financial conditions. Easing, as it sounds, makes things easier. Easier to borrow, easier to fund, easier to spend, consume, and produce. Tightening is the exact opposite. It makes things harder. Harder to borrow, harder to fund, harder to consume, and harder to produce. As a general rule, risk assets like stocks, commodities, and crypto perform better when financial conditions are easy or loose. Non-risk assets like currencies and bonds tend to underperform when financial conditions are easier. On the flip side, when financial conditions are tightening or expected to tighten, risk assets underperform, although there are exceptions because some assets have versatility. Now, currencies and bonds typically perform better under tight conditions or a tightening of financial conditions. Just remember, there are exceptions to these rules, but every exception has an explanation, which we will point out with examples. Okay, so the financial cycle is either easing conditions or tightening financial conditions, and this impacts growth and investment. Okay, now let's talk a little bit about why this happens. Financial conditions tighten when inflation rises above expectations, and when inflation is expected to be higher in the future based on new information. Financial conditions ease when inflation and growth are expected to slow, and ease aggressively when the economy is at risk of recession.